Hello, this is Professor Michael Fournet, and this is week 7 of the macroeconomics course. And for this week, we are going to look at two chapters. The first chapter is chapter 32, looking at the money creation process. And we also will look at a policy chapter this week, chapter 33, entitled Interest Rates and Monetary Policy. And because there is a lot of detail in both of these chapters, I'm going to break them into two separate lectures. And so the first lecture will focus on chapter 32, and the second lecture will be on interest rates and monetary policy in chapter 33. Alright, so we're going to look at in chapter 32 is the process by which through bank lending activity that banks or lending institutions like banks essentially create money. The banking system in the United States is organized on a fractionalized basis, which basically means that you will have a relatively small amount of cash in a bank at a given time, supporting a larger amount of checking account activity. So a fraction of dollars are available to support the amount of deposits in a given bank. And we're going to look at how that process works. Also, we're going to watch this process strictly through it's working through a single commercial bank. The text also illustrates how the process works through multiple banks, but I think the principle can still be mastered by just focusing on the process as it works through a single commercial bank. I'm going to use, to illustrate the fractional reserve system, I'm going to use both a case approach, and then I'm going to use a more efficient way of looking at it using something called the monetary multiplier. And so we'll be able to draw a conclusion to the fractional reserve system approach by using the money multiplier, because it's a more efficient way of tracking the fractional reserve system. The case approach that I'm going to employ is just to give us more details so that we can see how the process works on a kind of a systematic basis. So to kind of start the process, let's say that a deposit is made. Say that I go to a bank and I deposit $1,000. Once that $1,000 is deposited, I as a customer will get a deposit slip to indicate that my account has been adjusted for the amount of the deposit. But there's a kind of a transparent process that takes place that we typically aren't privy to as strictly retail bank customers. That is, within the banking system itself, that $1,000 that I deposit gets split into two parts. Part of it goes into a pool that's called required reserves, and the other part goes into a pool called excess reserves. Now, the required reserve pool, the amount that goes into required reserves cannot be loaned out by the bank. Banks make the bulk of their money through loaning activity. So when you make a deposit in a bank, the bank will use some of the proceeds to make loans, because they make a significant amount of their income through loaning. Now, the part of the deposit that goes into excess reserves, that can be used by the bank for purposes such as making loans. Alright, so here we get a sense of this fractionalization. We have a $1,000 deposit made in the bank, but there are $100 of required reserves there to kind of back it up. So on a fractional basis, a larger deposit is being supported by a smaller amount of required reserves within the bank. Now, the portion that goes into excess reserves, as I said, that's available for banks to loan to customers, and banks will try to loan out portions from the excess reserves to customers that appear creditworthy. The remaining portion of the deposit goes into required reserves, which cannot be loaned out, because if banks are given carte blanche right to make loans, they'll loan out all of a deposit, and that makes the banking system somewhat unstable. And so, how much of a deposit the banks are required to hold is governed by something called the reserve ratio. And the reserve ratio is put in place by the Federal Reserve. It's simply a percentage. It's a percentage of the deposit that banks must hold on reserve that they cannot loan out. And the reserve ratio ranges from as low as 8% of a deposit to 14%. So it's legally mandated to range between 8 to 14% of a deposit. And so we're going to assume for purposes of our illustrations that the required reserve ratio is 10%. So we're going to assume that R is 10%. So 10% of a deposit has to go into required reserves. And so when we go back to our previous slide, if $1,000 deposit, 10% of it, or $100, would have to go into required reserves. The difference then goes into excess reserves, and banks will try to loan out the portion of deposit in excess reserves. Now, the way what we're going to do is we're going to track through the money creation process. We're going to track what happens when a deposit is made and how that ultimately affects the size of the money supply. And for our purposes, the money supply will focus strictly on M1. So we're going to see how M1 changes when a deposit is made, when a loan is made. We're going to see what the effect ultimately will be on the money supply. And in those instances where the money supply gets bigger, the lender, such as banks, has in effect created money. So I organized kind of like a three-step process to walk through studying the fractional reserve system. The first thing we'll do is we'll take some retail bank transactions, strictly like a deposit or when the bank makes a loan, and we need to record that in something called a T account. A T account is just like an accounting tool to track activities, deposit activity and loaning activity within a bank. Once we have recorded the transactions in the T account, we will then look at their effect on the bank's reserve components. So we want to see how various components within the bank are affected based on the transaction in question. And then the last step, which is really the interesting one, is we'll analyze what effect the transaction has on the money supply. That is, does the retail banking transaction result in the creation of money? And we'll be able to determine that in step 3. Alright, let's take a case. Let's take case 1. And so we have this hypothetical bank that I'm going to call Bank A, and we're going to have a customer. We'll call the customer A. So customer A deposits $1,000 in Bank A. Okay, and so what we need to do is to record that transaction in Bank A's T account. And if you notice, the T account looks like a giant T. On one side you have assets, on the other side you have liabilities. And for purpose of this process, the only assets I'm concerned about are cash and loans. And on the liability side, the only liability that I'm concerned about is checkable deposits. And checkable deposits are a liability because it's not the bank's money, it's the customer's money. So the bank is liable to the customer for the amount he or she places in their checking deposit. So based on this first transaction, the customer deposits $1,000 cash in Bank A. So you notice the cash goes up by $1,000. We're just tracking this transaction where the bank may have $100 million in cash. We're just focusing on this individual transaction, trying to trace it through this process. So the bank gets $1,000 extra based on this customer deposit, and the bank is also liable to this customer for $1,000 because he or she presumably is putting the money in their checking account. So we recorded the transaction. The asset side, cash is assets are $1,000. The demand deposits, the liability side goes up by $1,000. So both sides are in balance. The next thing we do in step 2 is we have to look at the effect of this transaction on some various reserve components of the bank. And we're going to assume, as I indicated earlier, that the reserve ratio is 10%. So one reserve component we have to look at is called actual reserves. And actual reserves is easy to identify. It's simply what happens to cash. So in this case, the customer deposited $1,000 in the bank, so the bank's cash went up by 1,000. So actual reserve is simply the effect on cash. So cash went up 1,000, so actual reserves were 1,000. Required reserves is how we calculate the amount of a deposit that goes into the required reserve pool. And to do that, you take the required reserve ratio, little r, which in this case is 10%, and you multiply it times the deposit. So I take 10% times the deposit of $1,000. $100 would go into Bank A's required reserves. Now the excess reserves is simply going to be the actual reserves minus the required reserves. So if actual reserve is 1,000, required reserves is 100, the difference between the two will be 900, and so that will go into Bank A's excess reserves. Now once it goes into excess reserves, of course the bank will try to loan the $900 out, because that represents every time they make a successful loan, they earn interest and they make money. Alright, so that's looking at the effect on reserve components. The third step is to look at the effect of the transaction on the money supply. And again, we're going to focus strictly on M1. Alright, so we want to see how M1 will change. And so what happens is, this customer A came into the bank and deposited $1,000. So cash held by the public dropped by $1,000 when that customer gave the $1,000 to the bank teller. So cash held by the public drops by $1,000. Now that $1,000 that was given to the teller credits customer A's checking account by $1,000. So the bank's checkable deposits go up by 1,000. So the net effect is, when this deposit occurred, cash dropped by 1,000, checkable deposits went up by 1,000. So the net effect is that M1 does not change. And so in general, whenever you have a deposit, like in this case, or if you have a withdrawal, which is like, you think of a withdrawal as a negative deposit, in the sense that the customer would take money out of the bank, so cash held by the public would go up in the case of withdrawal, but checkable deposits would drop because the customer is taking the money out of his or her account. So whenever you have a simple deposit or a simple withdrawal, they have no effect on the size of the money supply. So no money is created in response to a simple deposit or a simple withdrawal. Okay? So far no money creation has occurred. Let's have another case. Let's say case 2, we have a different customer. Customer B borrows $900 from Bank A. So a totally different customer comes to Bank A and wants to borrow $900. And we're going to assume that this customer is credit worthy and the bank will be willing to make the loan to this customer. Alright, so we have to take this transaction and then show its effect on the T account. If you remember from case 1, the cash was $1,000, but this customer B is coming to borrow $900, so the $1,000 drops. So the cash amount drops from $1,000 to $100 because the customer got $900 loans. So cash drops by $900, and the bank will then credit its loan account for the amount of the loan outstanding. It's giving $900 to customer B, and so it'll adjust its loan account by $900. So cash drops from 1,000 to 100. Loans go from 0 up to 900. And so we add up the assets. The sum of the assets is 1,000. And notice checkable deposits on the liability side didn't change. Still 1,000. The bank is still liable to customer A for the $1,000 that he or she put into their account. So both sides balance. The assets will be 1,000. The liabilities will be 1,000. All we've done is reshuffle the structure of the assets. Cash dropped from 1,000 to 100, and loans increase from 0 to 900. Alright, and then we go to the next two steps. based on this transaction involving customer B, we'll look at the effect of it on the reserve components for bank B, and also see how it affects ultimately the money supply. Alright, so again, if you know the effect on cash, you know actual reserves. So cash, as we saw in the T account, is now $100, so that's what actual reserve is equal to 100. The required reserves, you take the required reserve ratio of 10%. There was no deposit made. The only deposit we're aware of is $1,000, and so the required reserves are still stuck at 100. So required reserves didn't change because we made a loan. There wasn't a deposit occurring in this instance. Alright, so to calculate the excess reserve, you take the actual reserves, which is 100, minus the required reserves, which is 100, and so excess reserves drop to 0. And if you notice in reading in the book, it said when a bank's excess reserves are 0, the bank is said to be fully loaned up. So when its excess reserves are 0, the bank at that moment cannot make another loan because it has just enough cash to support its required reserves. Now, when a bank if a bank were to get fully loaned up, that actually would be kind of irrational behavior for the bank, because when a bank is fully loaned up, it can't make any subsequent loans until its excess reserves have been to some degree replenished. And so when banks see their excess reserves starting to move into the danger zone, that is moving towards 0, they will take steps to try and build up their excess reserves. And there are several ways that banks will try to do this. One kind of natural way that banks try to build up their excess reserves is try to get customers to make more deposits. So if you get some promotional activity from a bank, like free coffee mug or some free checking, banks are really trying to get you to make a deposit because they know when a deposit is made, they get to play with 90% of the deposit. So to get deposits, that will make their excess reserves go up. Another way that their excess reserves could go up is they could borrow from other banks. So banks engage in loaning activity with other banks. So if a bank borrows from another, say Bank A borrows from, Chase Manhattan, and so the terms over which they work out the loan, there has to be an interest rate that applies. So if Bank A borrows some money from Chase Manhattan would then charge Bank A an interest rate for that loan. And the interest rate that banks charge each other for loans is known as the federal funds rate. So the federal funds rate is the interest rate that banks charge each other for loans. Alright, so banks can borrow from each other to kind of replenish their excess reserves. And as a last resort, banks could borrow from the Federal Reserve, because as we saw in the money and banking chapter, one of the functions of the Fed, it acts as a bank for banks. And so if banks find themselves kind of coming up short in terms of the excess reserve category, they could get a loan from the Federal Reserve. Now, the Fed would charge them an interest rate, and that interest rate is called the discount rate, as we will see later. The discount rate is the interest rate that the Fed charges banks for loans. Right? So a prudently run bank wouldn't let its excess reserves drop to 0. I'm doing it here so that we can kind of see how the money creation process can ultimately start to terminate. Alright, so taking the details of case 2 and looking at the effect on the money supply in step 3, we see something interesting here. In the first case, the customer came to the bank and made a deposit, so cash held by the public dropped by 1,000. Checkable deposits went up by 1,000 from the first case, and so we concluded in case 1 that there was no effect on N1. Now this customer B comes to the bank and borrows $900. So customer B comes to the bank with nothing, leaves the bank with $900, and so now there's $900 being held by the public. And so based on that transaction, cash held by the public goes up by 900. There was no effect on checkable deposits, and so based on this transaction, M1 gets bigger. So by making this loan to customer B of $900, the bank has in effect created $900 of money. So M1 got bigger by $900, and so the bank, by making that loan, increases the size of M1 by $900. Alright, so that's our second principle, is that whenever a bank makes a loan, it will in effect create money. And it begs the question, is this $900 that's created, is that all of the money that's will be created in this process? And the answer is no. Because once that customer B gets to $900, he or she is going to take the $900 and spend it. Let's say customer B spends the $900 at Dillard's. And so the customer buys $900 worth of goods and services using that medium of exchange function, buys $900 worth of goods and services from Dillard's. Dillard's would then take that $900 as part of its nightly deposit and deposit in its bank. And once that $900 hits Dillard's bank, that $900 will be split. 10% of it will go into Dillard's bank's required reserves, and the difference would go into Dillard's bank's excess reserves. And so the amount that goes into Dillard's bank's excess reserves will be loaned out, and the process will continue. So this $900 that we're seeing in case 2 is really just the first iteration of money that's created spinning from that initial deposit of $1,000. So all of this activity is resulting from customer A making a deposit of $1,000 in case 1. Now, to kind of look at this process more systematically, we can resort to something called the monetary multiplier. So I created a table that kind of shows us how money is going to be created as subsequent transactions occur in the banking system. So I have here our first transaction involved Bank A, and there was a $1,000 deposit. Of that $1,000, 10% or $100 went into Bank A's required reserves. The difference went in, 900 went into Bank A's excess reserves. Now that $900 we just saw was loaned out to customer B. Customer B takes the money and spends it somewhere, and wherever he or she spends it, let's say that Dillard's bank is Bank B. So Dillard's will deposit the $900 in its bank. Bank B will put 10% of it in its required reserves, and the difference, 810, will go into Bank B's excess reserves. Bank B will try to loan out the excess reserves. Once it's loaned out, it'll get spent, get redeposited in, say, another bank, such as Bank C. Once the $810 is deposited in Bank C, 10% of it, or $81, will go into Bank C's required reserves. The difference, $729, will go into Bank C's excess reserves, and the process will continue. And so if we could watch this process play out throughout its entirety, which is technically over an infinite horizon, we could tally up the end results to get a sense of how much money is ultimately being created. And the thing to focus on is the excess reserves, because banks make loans from their excess reserves, and so whenever the bank loans out of its excess reserves, that represents an addition to the money creation process. So if we could get a sum of all of the excess reserve values, that collective sum would give us the amount of money that would be created. And you got to remember, all this activity is coming from that first deposit of $1,000. Now, there's a neat way to do it. There's a neat way to get the totals. For example, in Bank A, we had the first transaction where $1,000 was deposited, $100 went into required reserves, and the difference, $900, went into excess reserves. So if you know the components of the first transaction, how much was initially deposited, how much initially went into required reserves, how much initially went into excess reserves, if you take those values and multiply them times something called the monetary multiplier, you can get the totals. So notice here I have the grand total for all the deposits created would be $10,000. The grand total for all required reserves would be $1,000, and the grand total for excess reserves would be $9,000. And this is interesting because the excess reserve total represents the amount of money that was created. Now, the monetary multiplier, the way it's determined, is you simply take, it's defined as the reciprocal of the reserve ratio. That is, I'm going to use M to represent the money multiplier, is equal to 1 over the reserve ratio. All right, so you take 1 over the reserve ratio. So, for example, in our problem, where we're assuming that the reserve ratio is 10%, you would take 1 over 0.1, and of course you would get the money multiplier would be 10. So you simply take 1 over the reserve ratio to get the monetary multiplier. Now, you use the multiplier once you have it. Like I said, you take the multiplier and multiply it times each initial component of the first transaction. Since we're looking at how the money supply will change, we want to focus on the initial excess reserve value. And from that previous table, the initial excess reserve value was 900. So I take the 900, multiply it times the money multiplier, which in this case would be 10. 900 times 10 gives me 9,000. For the grand total of required reserves, I take the initial amount of $100, multiply it times the monetary multiplier of 10, and I get a grand total of 1,000. I take the initial deposit of $1,000, multiply it times the monetary multiplier of 10, and I get a grand total of $10,000. Alright, and so as I've illustrated here, to determine the change in the money supply, you take M, which is the monetary multiplier, and multiply it times the initial excess reserve value. And that product, the multiplier times the initial excess reserve value, will give you the total amount of money that's created. So from that initial deposit of $1,000, that then spawned into the creation ultimately of $9,000. It is worth noting that if you run this process in reverse, that is, instead of having a deposit, if you have a withdrawal, it's going to create something called money destruction. So instead of money being created, money will be destroyed. Because if you're pulling money out of the banking system, that represents subsequent loans that can't be made, and so money in the process will be destroyed. So for a money destruction example, instead of focusing on deposit, you have a withdrawal, and so these would be negative. So you have a negative amount for the withdrawal, and all the resulting values will be negative, and so the end results will be negative, reflecting how much money was ultimately destroyed. Okay. Alright, so that's the basic principles of chapter 32, and in this chapter again I focused on the money creation process, filtering it exclusively through a single commercial bank so that we could see the workings of the relevant principles. And so for question purposes on examination, I would limit the questions to strictly what I've discussed here in this presentation. So keep in mind that there's also another video that you need to review this week on looking at interest rates and monetary policy, and I would suggest that once you're comfortable with the material in this chapter, that you review the video that I prepared and use that as a basis for getting a handle on the money creation process and ultimately how the Fed uses monetary policy to influence the economic performance of the economy. Alright, take care and take a look at the next video on interest rates and monetary policy.